Ouster delivered a highly missed Q2 2026 earnings report, missing consensus on the bottom line by a mile, but actually beating on the top line.
Right, and the market reaction was just swift and totally
Oh,
unforgiving.
yeah, it was brutal. They reported a net loss of 26 cents per share, or 27 cents adjusted, which widely missed the street's consensus estimate of a 12-cent loss.
But the revenue came in at $54.63 million.
Right.
That beat estimates of roughly $51.5 million.
Yeah, but the pain just didn't stop at the EPS miss. Guidance for Q3 2026 projects revenue between 54.5 million and 57.5 million.
Which is a relatively flat sequential outlook, when you compare it to the Q2 actual.
Exactly. And the stock was just punished for it. It
Yeah.
fell between like 8.4 and 10.5% in after-hours trading.
Dropping down to around $41.74, a really steep drop from its regular session close of $45.58.
Yeah, Wall Street looked right past that revenue beat and just zeroed in on the massive earnings miss and that stagnant forward guidance.
Absolutely.
So with those headline numbers out of the way, we really need to unpack the underlying details of this quarter for you, the retail investor. Because, a top-line beat looks great on a press release, right?
Sure. It always does.
But to understand if this growth is actually sustainable, we have to move directly into the segment performance and the unit economics.
Yeah, we have to see what products are actually shipping and where that demand is coming from.
Exactly.
Yeah.
Let's start with the volume. Ouster shipped over 17,000 sensors this quarter.
That's a record volume for them.
It is. It marks their 13th consecutive quarter of product revenue growth, which is a massive operational milestone. But, what really stands out when we look under the hood of those shipments is the Stereolabs acquisition.
Yeah, that acquisition is paying off incredibly quickly.
Right. Ouster bought this camera business, and in its first full quarter operating under Ouster, Stereolabs saw over 50% year-over-year product revenue growth.
And a lot of that is driven by the ZED-X Nano camera. Management explicitly called that out as the most successful product launch in Stereolabs' entire history.
Which is wild.
It is, because what you are seeing here is a fundamental shift in the end user.
Right.
This demand isn't coming from automotive companies trying to build self-driving cars. The surge is being driven by the humanoid and advanced robotic manipulation markets.
Okay, I want to stop you right there and just unpack this for a second, because I have to push back on the quality of this revenue.
Fair enough.
When a company acquires another business, it is incredibly easy to mask a slowdown in their legacy products by just, slapping the acquired revenue on top and calling it gross.
Oh, absolutely. The
Yeah.
classic roll-up strategy.
Exactly. So my question for you is this top-line beat genuinely organic growth from their core LiDAR business, or did they simply buy this revenue through the Stereolabs acquisition and mask a slowdown in their legacy products?
It's a great question, and the risk of bought revenue masking legacy decay is always the first thing you have to look for in a post-M&A earnings report. However, the product mix breakdown here actually points to synergistic expansion rather than some kind of cover-up.
Okay.
The core LiDAR business is still moving units, but the Stereolabs hardware is opening doors to entirely new, total addressable markets that Ouster just couldn't access before.
Because of the different technical requirements.
Exactly. Humanoid robots and robotic arms require entirely different spatial perception than, say, a car driving down a highway.
Sure, a car needs to see a pedestrian 200 meters away.
Right, but a robotic arm needs sub-millimeter depth accuracy to pick up a fragile component off an assembly line.
Oh, wow. Yeah, that's a totally different use case.
It is. So by bringing the ZED-X Nano camera into their portfolio, they aren't just cross-selling to existing clients. They're capturing the foundational AI models and advanced robotics platforms that require that extreme close-range precision.
So they are essentially proving that the demand for 3D spatial perception is aggressively expanding beyond just the whole robotaxi narrative.
Exactly. It diversifies their revenue stream away from the hyper-concentrated, highly volatile automotive sector.
Which is always a good thing.
Definitely. They're embedding themselves into industrial automation, logistics, heavy machinery sectors where the capital expenditure for automation is actually accelerating right now.
Okay, that makes sense. But I am really struggling to square that successful expansion with the EPS miss.
Yeah, the bottom line is ugly.
Right, because since unit shipments are hitting record highs, the next logical question is how those units are translating to the bottom line. And specifically, why EPS missed expectations so widely despite the revenue beat.
Well, if we move down the income statement to the margins, the numbers are actually phenomenal.
They are. GAAP gross margin expanded to 49%. That is up from 45% a year ago and 43% just last quarter.
And non-GAAP gross margin hit 53%.
Which is huge. For a hardware company scaling physical production, pulling 53% margins is just incredibly strong leverage.
It means the unit economics, the actual cost to manufacture a sensor versus what they sell it for, are fundamentally sound.
Exactly. So
Huh.
where is all that cash vanishing to before it hits the bottom line? I mean, why did they miss EPS by so much?
The operating expenses, they're acting as a massive anchor on the bottom line.
Yeah, the OpEx is wild.
It really is. Now, the adjusted EBITDA loss did narrow to $4.45 million, which is like a year-over-year improvement.
Sure.
But the raw operating expenditure is just staggering.
Right.
OpEx came in at nearly $47 million for the quarter.
$47 million in operating expenses against $54 million in revenue.
Yeah, it's a lot.
I mean, for you listening, a good way to contextualize this EPS miss is to think of Ouster right now as a factory.
Okay, I like this analogy.
Imagine they are massively expanding their physical footprint, right? They are
Uh-huh.
building out the factory lines, they are aggressively hiring engineers, but they are doing all of this before the order book is fully locked in.
Right.
So the unit economics on each individual widget rolling off the assembly line look beautiful.
Because of that 53% margin.
Exactly. But the heavy corporate overhead, the cost of keeping the lights on in this massive new factory, and the aggressive R&D spend, all of that is just eating the profits alive.
The factory expansion is the perfect framework to understand this specific phase of the company. That $47 million isn't just administrative bloat.
No, it's structural.
Exactly. It's the structural cost of absorbing stereo labs into their corporate ecosystem, integrating two totally different software stacks, and heavily funding the research and development required to ramp up entirely new product lines.
And for anyone holding this stock, management made it very clear this cash burn is not plateauing anytime soon.
Not at all.
They actually expect operating expenses to increase another 5 to 8% year over year as we move into Q3.
Yeah, they are leaning into the spend. They are investing heavily in production capacity and expanding their software portfolio.
Well, to justify that kind of relentless, heavy, ongoing operating expenditure to Wall Street, management has to be aggressively selling a new narrative.
They need a vision of the future to explain the cash burn.
Precisely. We need to look at what CEO Angus Bacala is saying about their strategic pivot.
He is pushing this new physical AI narrative incredibly hard.
Yeah, I noticed that. On the call, he framed the launch of the Rev 8 OS family as, quote, the most important product release in Ouster's history.
And the Rev 8 launch really is the technological linchpin holding up their entire valuation right now.
Let's talk about what's actually in it. The crown jewel of Rev 8 is the introduction of the world's first native color LiDAR sensors.
Right, all powered by their next generation L4 Ouster silicon.
And management claims this new silicon offers double the range and resolution of their previous generations.
Which is exactly what you want to see. But the native color LiDAR is where it gets really interesting on a technical level.
Oh, it's a massive leap forward in how machines perceive the world. Because traditionally, a robot or an autonomous vehicle has a camera to capture 2D color and texture.
So it can read a stop sign or, see the color of a traffic light.
Right. And then it has a completely separate LiDAR sensor firing lasers to create a 3D point cloud for depth perception.
Two totally separate data streams.
Exactly. And the bottleneck has always been that synchronizing those two separate data streams, matching the 2D pixels to the 3D points in real time, that requires immense compute power from the end user.
It's a huge processing burden. But by processing that integration natively on the L4 silicon inside the sensor itself, Ouster is essentially doing the heavy computational lifting for the customer.
So the sensor just outputs a single unified data stream.
Exactly. A stream where every single 3D point inherently contains color data.
That is so cool.
It dramatically reduces the processing power required by the robot's onboard computer. This simplifies system integration and accelerates the whole development cycle for the customer.
And the customer reception seems to really validate the tech. Management described the feedback as electric.
Yeah, they highlighted that Red 8 has already yielded multiple million-dollar orders.
Including a major heavy machinery manufacturer and some autonomous agriculture developers.
But, we have to play devil's advocate on the narrative itself for a second.
Always. I mean, let's be real. Every single hardware company on the planet wants to be an AI company right now.
because AI commands a higher valuation multiple on Wall Street.
Exactly. So my question is, are native color LiDAR and these new integrations true game changers for their total addressable market? Or is physical AI just a slick rebranding exercise to distract retail investors from the lack of gap profitability?
It's the multi-million-dollar question, and the market is clearly weighing that exact skepticism given the 10% after-hours haircut we talked about earlier.
Right.
The reality of physical AI sits somewhere in the middle of revolutionary technology and, frankly, corporate marketing.
Okay, break that down for me.
Well, take their partnership expansions, for example.
Uh,
Ouster heavily touted the integration of Rev 8 with the NVIDIA Drive and Jetson platforms.
oh, right. Providing a production-ready ecosystem for, what was it, 28 RV8 technology partners.
Exactly. And that NVIDIA integration is not just a buzzword. It is a structural go-to-market advantage.
Because it removes the friction for developers.
Yes.
If you are building an autonomous tractor and Ouster hands you dedicated NVIDIA toolkits that support direct data ingestion right into platforms like Jetson Orin, you don't have to spend 6 months writing custom software drivers to make the hardware talk to the computer.
Exactly. That time-to-market acceleration is deeply valuable to industrial clients. But the term physical AI itself is absolutely a strategic framing mechanism.
Yeah, it feels very manufactured.
Ouster is actively trying to pivot its identity in the eyes of the market. They want to shed the label of being just a commoditized hardware sensor manufacturer fighting in a race to the bottom on price.
Right, they want to be valued as an essential, high-margin AI perception platform.
Exactly. But that transition from hardware manufacturer to software-defined platform is wildly expensive.
Which brings us back to the balance sheet. Because while management paints a very bullish picture of a Rev 8 supercycle driving future growth, the balance sheet, the operational execution risks, and a very concerning pattern of insider trading present a distinctly bearish counter-narrative.
Retail investors absolutely must weigh this counter-narrative.
So let's look at how they are actually funding this massive factory expansion. In the first half of 2026, the company burned through over $20 million in operating cash.
And to fund that burn, ensure their survival, and build a war chest for this Rev 8 ramp, they relied heavily on equity dilution.
Heavily. During Q2, they raised $98 million via an at-the-market or ATM program.
And for you listening, an ATM program means the company is steadily selling newly created shares directly into the open market at prevailing prices.
Which dilutes the existing shareholders.
Exactly. And post-quarter, they went even further, completing another common stock offering that generated approximately $191 million in net proceeds.
So they flooded the market with new shares to fortify the balance sheet.
Yeah, they now sit on $263 million in cash and short-term investments, carrying zero debt.
And management emphatically claimed on the call that they do not need to raise any further capital to fund their current operating plan to profitability.
And look, from a pure solvency perspective, that $253 million cash cushion is bulletproof. The company is not going bankrupt anytime soon.
All right.
But that security came at the direct expense of early shareholders who just saw their ownership percentage drastically diluted.
It's a tough pill to swallow.
It is. Furthermore, a significant chunk of that capital is being tied up in working capital. Inventory spiked 33% sequentially, jumping to $31.43 million.
Now, management attributes that massive inventory build to prepping the supply chain for the Rev 8 product ramp.
Which makes sense on paper.
Sure, but building $31 million of hardware before the purchase orders are fully cleared introduces profound operational risk.
Especially because they are highly dependent on their contract manufacturer, Benchmark Electronics, to scale this production up to the 100,000-plus unit mark.
Right. Scaling complex optoelectronic hardware is notoriously difficult. Relying on a third-party contract manufacturer introduces vulnerabilities around component sourcing, assembly line calibration, quality control yield rates.
If Benchmark experiences supply chain hiccups or manufacturing defects, Ouster could face delayed revenue recognition.
While their cash just remains trapped in a warehouse full of unsold inventory.
Exactly, which compounds the product transition risk they are already facing.
Because management openly noted that shifting their massive customer base from the older Rev 7 sensors to the new Rev 8 architecture will take roughly 2 years.
Yeah, a 2-year transition creates a very precarious balancing act. You are basically introducing the Osborne effect into your own revenue stream.
For those who might not know, it's like trying to sell the final production run of the iPhone 14 the week after Apple publicly announces all the revolutionary features of the iPhone 15.
Right, your customers know the better technology is coming.
So if clients pause their bulk orders of Rev 7 because they want to wait for the Rev 8 sensors, but Benchmark Electronics faces a 3-month delay in ramping up Rev 8 production, Ouster suddenly hits a massive air pocket in revenue.
Exactly. They have to manage this 2-year customer migration flawlessly to maintain that 13-quarter streak of revenue growth.
And here's the thing. If management is so confident in this Rev 8 supercycle and their ability to navigate this 2-year transition without missing a beat, you would expect the executives to be aggressively buying up shares at this post-earnings discount.
You'd think so, yeah.
But that brings us to the biggest red flag for retail investors in this entire report.
Insider selling.
The internal trading activity. The C-suite is doing the exact opposite of buying.
Yeah, the regulatory filings paint a very stark picture of internal sentiment. Over the last 6 months, insiders made 48 open market trades.
And 47 of those trades were sales.
Only a single trade was a purchase.
And we aren't talking about low-level executives exercising a few stock options to cover their tax bills.
No, not at all.
The chief technology officer, Mark Freitel, dumped over 884,000 shares for an estimated $30 million. The chief operating officer, Darian Spencer, sold $3.4 million. The CFO and the CEO also sold shares.
You always hear the classic defense that insiders sell for plenty of reasons, right?
Sure, diversifying their portfolio, putting kids through college, buying a new house.
But a $30 million liquidation by the CTO isn't a house fund.
No, it's not. It forces the market to question the internal conviction in the company's stated valuation.
It really does. When the ratio is 47 sales to 1 purchase, and the chief architect of the technology liquidates tens of millions of dollars of equity precisely during the quarter you are launching the, quote, most important product in company history, it sends a chilling signal to the retail base holding the bag.
Especially when you consider the premium Wall Street is currently charging for this stock. Even after the after-hours drop, Ouster is trading at a rich 14.2 times price-to-sales multiple.
That is an aggressive valuation.
Very aggressive. You do not pay 14 times sales for a hardware company that is still figuring out its supply chain bottlenecks or navigating a risky 2-year product transition.
No, you pay a 14x multiple for flawless hyper-growth execution.
Right. And I think the market looked at the holistic picture. Yes, the top-line revenue beat estimates. Yes, the margins expanded to 53%.
But when you factor in $47 million in quarterly operating expenses,
the heavy reliance on equity dilution to fund the balance sheet,
and a C-suite aggressively cashing out ahead of a major product transition,
the institutional investors decided the risk profile simply did not justify a 14-time sales multiple.
The after-hour sell-off was a direct recalibration of that exact risk.
So what does this all mean for you as you evaluate your portfolio? Ouster has undoubtedly built incredible technology. By integrating Stereolabs and launching native color LiDAR, they are successfully proving that spatial perception demand is expanding rapidly out of the automotive sector and deep into industrial automation and robotics.
And the unit economics prove the hardware is actually profitable to build.
Exactly. But the cost of running the corporate machine is expanding just as fast as the revenue it generates.
So retail investors have to weigh the tension between an expanding top line and a bleeding bottom line. You have to decide if buying into this physical AI revolution is worth the inherent risks of rising overhead, potential supply chain friction at Benchmark Electronics, and executives quietly heading for the exits.
Right. And here's a final thought to mull over as you digest this earnings report. As Ouster pivots hard into this physical AI narrative and targets advanced robotics, they are fundamentally shifting their competitive landscape.
You really are.
They are no longer just fighting other LiDAR manufacturers for a handful of robotaxi contracts. They are stepping into the arena with massive AI vision companies and legacy industrial giants who have infinitely deeper pockets.
Oh, absolutely.
So the ultimate question moving forward isn't just whether Ouster can build the best hardware sensor, it's whether a hardware company can successfully monetize a software-defined AI ecosystem before their cash runway finally runs out.
That is the defining challenge for their next several quarters.
Make sure you follow the show for daily earnings coverage to see exactly how this transition plays out.